Peace. In this video, I'm going to really give it to you. I'm going to break down the anatomy of a trade, okay? Now, I'm going to give you some of the jewels. I'm not going to give you all of them. You want the jewels? Hit me up on Patreon. Let's schedule a one-on-one consultation, and I'll bless you with the golden ticket, okay? So, without further ado, let's get into the anatomy of a trade. As promised, let me break down for you how I pulled off that Nike trade. Let's quote that great poet, Nasir Jones, who said, "I'm a Nike head. I wear chains that incite the feds." Okay? And here's the anatomy of a trade for Nike. Okay? I myself have several pairs of Nike. It is one of my favorite sneakers. I don't know what the exact name of them is, but I have the Nick color foamposite Nikes. I have some camo Nikes. I have a slew of Air Max Nikes. List goes on, and I'm sure a lot of you out there in YouTube land can relate. So I knew that Nike had an earnings announcement on the 24th after market close. Okay. The first thing I did was take a look at the stock chart. Okay. This is not the best chart here, but you can see when you look at this chart, the first thing you're trying to ascertain is, has the stock price been going up? Has the stock price been going down? Has it been going sideways? Has it been in a holding pattern? The reason that you do this is to try and see if you can spot an edge on the chart. You know, earnings reports are funny. Sometimes a stock will take off even on bad earnings, and sometimes it'll sink even on great earnings. So if we look at the stock chart and see if it's been trending up or trending down, that may be a clue to how it may perform when the earnings announcement is released. Okay. The next step is to try and calculate the expected move. And there are some websites out there that can help you to calculate this expected move. You can go to NASDAQ.com, or you can go to barchart.com. Even the stock chart can help you kind of estimate where you think the stock will land after the earnings are announced. And once you do that, you make an assessment. You make a educated guess as to where the stock will go. And this is specifically for an option play, because then you want to try to chart or pick which instruments you're going to use. So after calculating the expected move, I decided to go with the 130 put and the 135 call, both expiring on the 16th of July. Okay, so when we talk about who the 5% are, I'm telling you about how I put this trade together. I decided, and this is evidenced by the two strikes that I selected, the 130 put and the 135 call. I spent just about $600 to place this trade. The call cost me $343.51. The put cost me $248.51. Okay, so that option strategy is called a strangle. And a strangle is an option strategy in which the investor holds a position in both a call and a put option with different strike prices, but with the same expiration date. And obviously the same underlying asset. A strangle is a good strategy if you think the underlying security will experience a large price move in the near future, but are unsure of the direction. Okay? So no one knows what's going to happen, and no one knows how the stock will react to the earnings report. Okay? So that's why I chose to go with the strangle. I expected there to be a huge move, just didn't know which direction it would be. I did kind of feel that it would be a positive move just because of the fact of, everybody being, locked in, you know what I'm saying? And, all this online shopping. I myself, during the pandemic, purchased a pair of Nikes online. It was my first time ever buying a pair of sneakers online. Okay, so I just anticipated that to be good, and obviously Nike is a great company. So before we get into how it turned out, I just want you guys to know, don't try this at home. If you are new to options, okay, don't think it's just as simple as doing a strangle on every earnings play and you're going to be able to have a successful trade. Okay, there's some other factors that play a part, and there's a lot of minutia involved with options, especially with the Greeks. Check out my video on the option Greeks, because that definitely plays a part in what happens with those contracts. Okay, and again, earnings plays are very, very risky. I've been in earnings plays. I remember I did an earnings play on, I think it was Walmart and Target, and this was last year, I believe, during the around this same time last year. And I just, calculated that all of the retailers were having great earnings reports. They were being received well. So I felt like, well, Walmart should do it. It was either Walmart or Target. I really think it was Walmart. And initially, there was a pop in the stock, yet the next day, I got burnt on both sides, both the call side and the put side. Could be that it was baked in. Could be, volatility was too high when I purchased. So earnings plays are very dangerous in that aspect, that even though your theory may be right, the price may be right, the direction might be right, or it just depends on how the market receives it. And then there's something called the volatility collapse. So a volatility collapse can kill both sides, can kill the calls and the puts, because volatility will tend to rise into a huge event like an earnings report. So volatility on those contracts is going up, therefore the prices are going up. Now the earnings are announced, the volatility collapses. That event is gone. So those prices will come down. And if you don't get a significant move, like the Nike play, that was a significant move. It moved $18. That's a huge move. Sometimes you don't get a huge move like that. Sometimes it'll be within a $1 range, and you'll be looking at yourself like, yo, why is this? You know what I'm saying? These earnings are fabulous. Okay, so there's a lot of other factors involved in putting on these type of plays. If you're interested in doing that, again, hit me up on Patreon. Let's schedule a call, and I can talk you through specifically. Okay, if you have some questions, go ahead and leave them down below in the comments. Okay, so my 135 call was the money maker. That 343.51 went all the way to $1,779.48. Okay, the 130 put, of course, got roasted. Okay, I paid $248.51 for that. I had to close that contract at $13.48. So that was a loss of $235.03. So you take the $1,779.48 minus $235.03 minus the $343.51, which was my initial purchase price for the 135 call, leaves me with a profit of $1,200.94. Okay, and that, my friends, is the anatomy of a trade. If you're new to the channel, go ahead and subscribe. Mollywop that like button real quick and hit the notification bell so you can know when I come out with more anatomy of a trade videos. This is your brother in trading and investing, Absolute Truth for Law, signing out for the Absolute Boss Collective. Peace.